Ladies and gentlemen, good day and welcome to Timken India Limited Q4 FY24 earnings conference call hosted by Avendus Spark. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ram Seshan from Avendus Spark. Thank you, and over to you, sir.
Hi guys, good evening. This is Ram from Spark Capital. Appreciate everybody logging in. Very pleased to be hosting Mr. Sanjay Kaul, Chairman and Managing Director of Timken India, along with Mr. Ravishrant Keshwa, CFO, to discuss the 4Q results. We'll start with brief opening remarks from Mr. Kaul, followed by a Q&A session. Mr. Kaul, all yours.
Thank you, Ram. Thanks a lot. Opening remarks, I would keep limited so that we can directly go to the Q&A. However, the highlight of the Q4 23-24 performance were that we had a record quarterly revenue of 898 crore, which were up double digit from the last year same time. Mostly rail and domestic sector. Unfortunately, the exports were down. And we still see that export markets are not going to be buoyant in short to medium term. And obviously, we are also having an election here, so that is also full of challenges. Otherwise, the performance remain solid, and also currently, we are working very hard on our new plan, which is coming up as per plan. Other than that, I would go to the Q&A and add more value to that. Over to you.
Let's start the Q&A, please, Muskan.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking the question. Ladies and gentlemen, wait for the moment while the question queue assembles. The first question is from the line of Krupa Shankar from Avendus Spark. Please go ahead, sir.
Yes, sir. Good afternoon, and thank you for the opportunity. Just first up question is on exports side of things. Just wanted to pick your brain on sequentially how you're seeing things improving on the exports piece, and if you can throw some color on the Class 8 demand as well, and how you are seeing that shaping up.
So on the export side, as you all know that we export to both the global rail markets out of Timken India Limited, and also we export for the heavy truck to the different markets around the globe. On the rail side, South America is pretty robust, so they are doing pretty well. That market is doing pretty well on the rail side. However, on the heavy truck side, it is not where it should be, and it is soft, and the soft landing is not expected in the H2. Looks to be in the short and medium term it will remain soft. However, the rail markets are doing well in South America for a change, and North America is okay, but the heavy truck market is for sure not doing well. So that is looming large, and then the US market will have their own elections in November, so that is a little bit of an uncertainty there. Other than that, the local markets, especially the rail in the domestic market, is doing pretty well. Australia is flattish. ASEAN flat to low, China, especially for wind, pretty much down. So globally, there are some pockets of bright spots, like Israel in South America. Other than that, India obviously is holding on, and no other major India style that kind of GDP growth is not happening in the near term.
Got it, sir. Sir, also a bookkeeping question, if you can share the revenue breakup for the quarter as well as for the full financial year, that would be really helpful.
Yeah. So the Q4, our revenue breakup was, rail was 34% in the quarter, and mobile others was 17% of the 898 crore of that quarter, and distribution was 19%, and process industry, which is stationary equipment, was 17%, and the exports were 14%. So that was for the Q4. And then for the full year, the rail stood at 23%. The mobile, which is the heavy truck off-highway, was 20% of the pie, and distribution was 18%, process was 19%, and exports was 20%. And if you see, that was the whole year, 23-24, and if you compare this with 22-23, rail was 17%, and this year we completed, the pie was 23%, and mobile others remained flattish, 20-20, distribution same, 18-18, and process was 16 in 22-23, went up to 19, and the exports came down from 28% in the pie to 20%. So definitely we had almost 20% in the quarter on the export side. So that was which was heavily made up through our rail trade.
Thank you very much, sir. I'll get back in the queue.
Yeah.
Thank you. The next question is from the line of Abhishek DSP. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity, and thank you for those initial comments. Sir, just coming back to the current quarter, we have seen very strong growth as far as railways is concerned. Any thoughts? Is it led by more, wagon manufacturing kind of happening, and that's resulting in more bearing requirement? Is it Vande Bharat, or is it just one-off? Any some indication on the rail sustainability part as far as growth is concerned, sir?
Rail, obviously, the rail market is pretty much buoyant in India currently, both from the fact that more wagons are getting built, and then also Vande Bharat, and then whatever little bit of metro, and also locomotives. So rail certainly is going to remain, as I always say, that this rail will always be better than the previous years for many, many years to come. India has to do a lot more in railway, and the intent of the Rail Mantrala is very much there. So that is on. That is why we see Vande Bharat, we see speeds going up, we see electrification happening, and we see double tracks being laid wherever there was single tracks, which means that they want to put more trains on the tracks, and then dedicated freight corridors slowly, steadily picking up as they get more land. Definitely, they want to move freight out of the normal lines and keep passengers as lean as possible, so that more passenger traffic can be taken. So to your original question, it is a sustainable model, and that obviously, in a quarter to quarter might be a little bit of aberration here and there, but year on year there will be always growth for next many years for rail in India. So that would be my answer for that.
Okay, that's very helpful. So would you still be maintaining a 50% market share, or would your market shares have moved up in railways?
We have it has moved up a little bit. So as you know that we've been in railways from our parent company also in this game for many years, and then we have created the optimum supply chains for railways. Our center of excellence of railways is in Jamshedpur in India. And then also on technology front, which we get from our parent, we are continuously upgrading those. And whether it is sealing technology, whether it is greasing technology, whether it is the material science of it, extra, so that the residual life of these bearings go up and uptime of the rail in itself goes up. So that would remain to the core of it.
Okay. So, but just in terms of the railway part of it, you think you have enough capacity, or at some point will you also have to add capacity? Any thoughts on the same?
Good question. Certainly, I think the rail capacity as it goes today, and we also exporting it in some markets at times are behaving like South America is behaving pretty well. And we are looking at these capacities very closely, and so that we don't want to be saddled with fixed cost, but at the same time, we don't want to be saddled with non-capacity. So this is a very good point for evaluation, and we are evaluating and seeing how do we increase the throughput and also the base capacities. We have not taken any decision yet as we speak, but it is on our active consideration list.
Okay. So the other segment which has done well for you is the process part of it, which has been seeing healthy improvement. Sir, any thoughts, because that's a segment which caters to the steel, cement, and the power part of it, and we are seeing a lot of steel capacities coming, cement capacities increasing, a lot of solar panels are being put up. So any thought on the growth trajectory of this segment, which is process industry? Thanks.
Yeah. So both in terms of putting the new steel capacities in, which means that more mills would come in, and then also continuous running of the steel mills so that the output is harnessed. So steel industry certainly will remain pretty healthy in India, and it should be. You know, our per capita consumption of steel is low. If you see countries like China and others, so our per capita consumption is pretty low, and we need to produce more steel, sustainable steel, green steel. But they all form of steel will need bearing. And Timken obviously for ages around the globe are well versed in the technology of the rolling mills and how do you produce those bearings. And as we speak, our Bharuch plant will also help us in this area, whether it's cement or it is power or it is steel. And we must be the only company in India which run more than 26, 27 roll shop inside the steel companies. You name the steel company, we are inside there 24/7, de-choking, mounting, remounting, and things like that. So this market will remain pretty nice as we need more steel for building the infra in India. And we from the Timken India side will remain close to the customer and will make sure that we ride the wave as it comes. And it is obviously, you know, we all know that a lot of steel companies are investing, enhancing capacities, and also producing more and more. The shape and a little bit might change. People might start putting more electric arc furnaces, which means that they would like to reuse the scrap steel, etc. But they have to do rolling. You know, they have to do rolling and things like that. So we see a nice growth in this market.
Great, sir. So one last question. In terms of the new capacity, we see fair amount of capex being done, almost about 260 crores kind of operating cash flow has kind of got invested or capex has been done. Any thoughts on the timeline, sir? Are we on time to get it up and running by fourth quarter of FY25? When can one see the traction?
So just to give a flavor, main shop floor civil work has been completed, and our pre-engineering building is all up, and roofing is in progress. our major high tension wire cabling, extra routing and all that substation switchgear work is in progress. I'm glad that our system, ERP system is already in place and is live currently for the new plant, and likely production start is same as per plan. So we should be able to, the machines are, either on the seas or on landing in Bombay from different parts of the world, as this is going to be a high-tech plant with a lot of robotics and IoT and things like that. So things are moving. And to the direct short reply to the question is that we are on time and should be P-papping by the end of this year and commercial production thereafter.
Great, sir. I have few more questions. I'll come back in the queue. Thank you so much.
Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Life. Please go ahead.
Yeah. Hi, sir. Good afternoon. Thanks for your time as always. Just going back to the export piece, and if I heard you right, I think you said, in the quarter gone by, exports were at 14%, 14, right? Which possibly is one of the lowest we've seen in a very long time. So are we, obviously there would have been both a YOY and a sequential decline there. But are we like near or at the bottom, and therefore at least going into the next few quarters, we start seeing an improvement, or is that also a little difficult to call out?
So I would say that yes, this quarter was among the lowest. Definitely, you are absolutely right, bang on. This was among the lowest. While the next quarter might be a little bit better, but the idea of soft landing, which was earlier thought that by H2 US market would be up and running with full speed. That is not seen by us, both our principal and we from here looking at that window. It is going to remain a little bit soft for sure. And short term, medium term, maybe the last quarter was among the lowest. I think it is bottomed out, and next quarter might be slightly better and thereby, but kind of going up like a hockey stick is not happening this year. But definitely next quarter might be better than the previous quarter, and thereby next slightly better. But overall, short term, medium term, export markets would remain soft, which means that if you look at the calendar year, January to December would be kind of soft, with the January to March among the soft sets.
Right. And I'm just wondering, because is it primarily driven by the weakness you expect in the heavy truck, the Class 8 market in the US? Because I thought you said the rail markets are doing okay, right? So it's more to do with the decline in the US market?
Yeah. So rail markets in South America are doing well. Rail market in North America are okay-ish. And heavy truck market is not doing well.
Okay. So, okay. Fair. Okay.
And then we are also exporting. Australia is also flattish. ASEAN is actually low. And so, overall it is for the heavy truck, and even in India, the heavy truck is also flattish. So, so it is a little bit of a global phenomenon.
Fair. And are we, or is the parent also exploring options for maybe sourcing more from us in India? Is that an offset or a lever that we may have as well?
So the global supply chain folks are always looking at options of sourcing, resourcing. But as you know that resourcing, changing source is like steering a very big ship, cannot be done overnight and things like that. So the evaluation of sourcing, the resourcing, all that will always be there. But the plants we have a plant in Mexico. We have obviously plants in different parts of US, and we have a plant. The parent has a plant in China, etc. So sourcing from India will remain attractive. But overall, the markets are not really doing so well. So including the off-highway market in America, even that is not doing that well.
Fair. Okay. And just on the distribution piece, right, which is the aftermarket, I'm assuming a more stable and also more profitable business for you. Fair to assume that keeps on growing in that 10-12% kind of a range in line with maybe nominal GDP. Is that a fair assumption? And also, what is driving that growth there?
So, when you talk about aftermarket, there are two kinds of aftermarket. One is the MRO business for the industry. Say, for example, steel company needs to produce bearings, cement needs to produce cement, energy needs to produce energy. So obviously they have their life cycle for the bearings. So that market will keep on growing, and your GDP is 6, and any good company wants to outgrow the market. So if your GDP is going to 6 to 7 and you want to outgrow by, say, 50%, so you will grow double digits. That MRO market is bound to grow and grow. The other market is the auto aftermarket. So when new trucks are not built and auto aftermarket is obviously using more trucks or is carrying more payload and is obviously consuming more bearing. But auto aftermarket in India is always going after, especially the wheel end, going after cheap bearings, and differential premium doesn't get replaced so fast. So on the one side of industrial distribution, where we focus more, is going to remain pretty solid, and the auto aftermarket is going to be commoditized to a large extent, which is happening in the market.
Right. And just a last one on our utilization levels, both in Jamshedpur and in Bharuch. Fair to assume, while exports are a little weak, the strong growth in rail and the other industrial aftermarkets should kind of keep us fairly busy.
So Jamshedpur is running 6 days, full 3 shifts. Bharuch is also running more or less full. We don't see that going down. But Jamshedpur is running flat out. I would say our Bharuch plant might be a little bit 5% less loaded. But overall, both plants are running currently, as we speak, are running full.
And if you could also just give me the comparable, the sales breakup for Q4 23. I think you gave the number for 24. If you could just share the same for the last year. Thank you.
So Q4, if you want Q4 of 22 and 23, the rail was 23%, mobile others was 20, 19 was distribution, 18 was process, export was 19.
Got it. Great. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Rishi Vora from Kotak Securities. Please go ahead.
Yeah, thank you for giving me the opportunity. Sir, first on the margin side, if you look at it on a YOY basis, our margins have improved by 300 basis points. While operating leverage would have played its part, but at least in terms of mix, if you look at it, railway has done better and export has declined, which in terms of mix is inferior. So what explains the margin expansion, and do you think these margins are sustainable?
So margin performance largely is driven by volume and product mix. So utilization was better, so that helped because when you can over leverage capacities, so that has an impact on the margins. And the second is that post COVID, the industry has been relentlessly leveraging cost or cutting waste or making sure that the waste is out of the system. And now, because of the push on ESG, especially sustainability, so everybody is trying to see and make sure that these supply chains are circular, they are shorter, smarter. So I will say that an answer to your question, strong margin performance in the quarter largely was driven by favorable volume and product mix, and the better cost leverage we have been trying to do in the area of supply chain. And on top of that, despite the fact that steel prices have come down, labor obviously keeps on going up. So we have been working very hard on price realization, and that has remained pretty much our continued effort on price realization despite softening of the metal prices. So that we are, generally the OEs would only look at steel. Now we are trying to discuss and bring their focus on the other aspects of the pricing. It is not only steel pricing, and when you are a natural supplier, how much productivity increase can be done over a period of time when you are already supplying for 40 years. So that is also a go-to strategy, especially when the application is where you can harness value. I hope that answers the question.
Thank you. The next question is from the line of Rajesh Kothari from Alpha Advisors Private Limited. Please go ahead.
Good evening, sir. Just a few questions from my side. The first question is on the railway side. Can you please share in terms of this growth? Because generally, the railway capex is yet to happen in a big way. So over next 2 to 3 years, do you expect this segment to continue to grow at 25 to 30%? And if yes, how much you think is primarily driven by, say, Vande Bharat and metros compared to, the freight related railway segment?
So I can't tell you whether it will grow 25 to 30%, but as I've been telling over the years that rail in India will always grow. The growth might not be like a huge hockey stick, but it is bound to grow year on year. It has to grow for the simple fact that we don't have enough track kilometers. When you lay more tracks, you need more trains, you need more stuff, and as you produce more steel, as you produce more cement, then you need those wagons to transport it. Then we have an aging wagon population as well. Despite the fact last 5-6 years we've been pushing new wagons, but still 300,000 population of these box and wagons need to be overhauled, especially replaced, especially because of the fact that dedicated freight corridor is slow, and you cannot afford to have a bag wagon or a hot axle on a track where the passenger is coming every 2-3 minutes. So long story short on this is that Indian Railways will grow YOY. It will keep on growing. Some years it will be better, some years it will be a little bit less better, but it will keep on growing. The other question is that India on the mass rapid transportation is bound to invest more. Every state, every city needs metro because of the fact that the roads within the city are limited. So your metro population will keep on growing. But then metros don't use mass amount of cars and bearings. But it is still a segment which will keep on growing. On Vande Bharat and related area is that now the good old Shalarian passenger car, which was the workhorse of Indian Railways, needs to be replaced all over India because of the fact that it has limitation on safety, etc. So the modern coaches of Vande Bharat and speed enhancement, etc. will keep on happening. And as you see Europe, as you see China, the speeds are much higher. We still have to catch on the average speed of say 175 kilometers and then maybe beyond that. So this segment will also keep on growing. So whether it is 25% or 30 or 10, but every year will be better than the previous year. And the capex obviously has to happen. Now some years they might be able to buy like last mega tender was 90,000 wagons, and then there was a little bit less. Then again they are working on a master plan. So the master plan on infrastructure certainly has a major play for railways. And electrification, 1,000 locos a year and all that stuff. So this sector in India will grow for many years. Now whether it will grow 20 or it will grow 5, but it will keep on growing.
So while I clearly understand the macro tailwind, what we are witnessing, but in terms of the visibility, so typically how it works, you get a visibility for next 12 to 18 months because say companies like Texmaco or Jupiter, they might be, you might be supplying to them. So they give the advance orders to you, which has to be executed over 12, 18 months, or is it like every month you get the orders and then you have to supply to them?
Yeah, railways generally tend to be long-term orders. So then, you win a bigger order and then you keep on supplying. So it is not even even in, even in a OE making truck, he will do an annual contract and then pick up based on his demand. And same goes for the wagon builders. They will do a large, if, for example, Mr. X building wagon gets